And good afternoon, everyone. My name is Jeffrey Tesch. I'm CEO of RCN Capital. And welcome to this week's panel, REI Inc. presenting Funding Strategies, Expanding Your Portfolio. A big thank you to Suzanne and Robert from REI Inc. for putting this panel together today. This panel certainly has been one of the most anticipated gatherings over the course of our 8-week session here as investors from all across the nation really want to be able to drill down on how to get their existing deals funded as well as expanding their portfolio in these new uncharted waters. And we have put together an outstanding group of panelists today, both with expertise from not only their own individual lives, but their companies. And I got to tell you, what a panel it's going to be today. I am going to start off with Mr. Nathan Long from Quest Trust. Welcome aboard, Nathan. A little bit about yourself and your company.
Thank you for having me. Again, my name is Nathan Long. I'm the president of Quest Trust Company. So we hold private assets inside of retirement accounts. One of our largest segments of assets that we hold, of course, we hold private real estate and people that buy like apartment complexes and that, but tons. Our largest asset class at Quest is lending. Most of it is lending to things. So I have a lot of experience through my work. I've also been a real estate investor for about 35 years and a lender, a private money lender myself, as long with my family for a long time. So I've got a good perspective from what it looks like from the private money lender, the guy that you guys are often looking to come in contact with, a guy like me.
Love it. Love your varied experience, Nathan. Thanks so much. Next up, we have Jennifer McGuinness, founder and head of Aggregation Structured Finance with Mortgage Venture Partners from sunny Dallas, Texas. How are you, Jennifer?
Well, it's definitely not sunny today. We got some sunny high winds and rain going on here. But hi, Jeff. How are you? Hi, everybody.
Great.
Jen McGuinness. I run Mortgage Venture Partners. We are a closed loan aggregation business, which basically means we acquire loans originated to our specifications from a vast array of lenders. We focus on non-QM, QM relevant, and the single-family rental business purpose space. Historically, the best context for this particular panel is I was the head of single asset lending for Colony American Finance, which is now known as CoreVest, and helped create those lending programs, the securitization structures and strategies, et cetera. And I'm looking forward to the panel today. Thanks, Jeff.
Appreciate it. Thanks so much, Jennifer. Next up, we have Kendra Rommel, Manager Sales from Civic Financial Services, head of the Rommel team. Kendra, so great to have you on board today.
Thanks, Jeff. Hey, everyone, it's Kendra with the Rommel team at Civic. We are a private money lender, clearly specializing in bridge, fix and flip, and rental. Believe it or not, there is still rental holding on. So I'm super excited to be among the group here and excited to learn as much as probably everybody on the call and offer whatever information I can that will help you all scale your business during this time.
Thanks so much, Kendra. Great to have you on board as well. And finally, we have Jacob Therrien, Business Development Specialist from Bridge Loan Network. Oh, welcome aboard, Jacob.
Thanks, Jeff. Glad to be here. Again, my name is Jacob Therrien. I'm here with Bridge Loan Network. Bridge Loan Network is a loan origination software at our heart. We have broker-facing software as well. I personally work with lenders in every corner of the country and everywhere in between. So I have a pretty good pulse on what's out there for financing options across the country.
Thank you so much, Jacob. Looking forward to your detail. And once again, my name is Jeffrey Tesch. I'm CEO of RCN Capital. We are a nationwide lender in the private money space. Started our company about 10 years ago out of the previous crisis. Started humbly on the East Coast, wanting to take private money and professionalize it all across the nation. Not only short-term bridge, buy, fix, and sell, but also longer-term rental, whether it be single asset portfolio or working with aggregators on these single-family rental programs all across the nation. We're just outside of New York City and Connecticut. Really proud to be with you today and moderating this panel. So today, getting into funding strategies and how you, the investors, can expand your portfolio. This really drills down to what we've been talking about over the last 8 weeks, which are best practices, best processes, and really how folks can understand how to be successful in these hard, difficult times. And with that said, Jennifer, I'm going to start off with you as really one of the senior aggregators in the space, working with various lenders. You have an outstanding pulse on what is happening from the beginning of the crisis to midway to where we are today. Jennifer, I would love for you to bring us up to speed on what you're seeing across the lending landscape nationwide.
So I think we can all very honestly say that it's been a hot mess, okay? I don't think anybody could have predicted a pandemic, and if you find me somebody who could model this, I will hire them to work on my team. But needless to say, when you think about it, what happened? We ended up with a global pandemic that came out of nowhere, and a vast array of states were put on lockdown based on the fact of what that pandemic could do to the health of, the population of the United States. When that happened, the market reacted probably way worse than they did in the financial crisis of 2007, 2008, because they're afraid of the risks that come with that. So, as I'm sure most of the investors on the line and the lenders saw, lending pretty much dried up in the space so that they could figure out what was happening. But the question is, why did that happen? Well, first and foremost, in order to fund these loans, each of those lenders need to have a warehouse facility in order to actually give the money to the investors, be it buy-to-rent, fix and flip, or long-duration landlord loans. And majority of those particular funding facilities decided to either double the amount of cash that those lenders now needed to put up for those loans, or it could have been an and or an or, because it happened in some cases both ways, margin call every asset that they already had on those facilities. And that basically means if they believe that the value of the loans that were on those facilities have decreased, that they're going to ask the lender to make up the difference. On average, across this market, the lenders were margin called for 15% of their entire portfolio that was on those facilities. For context, if you had $1 billion worth of loans on a facility, that's a $150 million bill sent to you in the morning that they expect you to fulfill by the end of business that same day. Okay? That doesn't happen quickly for an aggregator or a lender. And many of the lenders that, were a little bit more unlucky, obviously didn't have the cash to cover that. And then on top of it, they lost some of their loans, and some of those loans began to be fire sold out in the market. That happens to both the single-family rental businesses as well as a lot of the residential mortgage businesses. Then the lines basically said you can't fund any more loans, okay, or double the amount of money that you put up, and these businesses really aren't structured that way. So that's the first impact, okay? The other thing that happened is, fundamentally speaking, right, this asset class from a rental cash flow perspective, and we're not going to talk about the bridge loans for a second, but we'll get there in a second, is underwritten to rental cash flow. The government started talking about eviction moratoriums and get out of jail free cards on paying your rent. While the impact hasn't been as big as they thought, on average, you've seen a 9 to 18% decrease in rental payment cash flow. When that happens, the bond investors that would buy the bonds that recycle this money for these lenders also will pay you less for the bonds. So if it costs you more to finance the loans so that you can give the money to the investors, and you don't have a manner in which to get that money back to pay off those facilities through the securitization market, what is a lender to do? They either need to stop lending, or they need to renegotiate those facilities and figure out how else they can recycle their money, which is why you saw a very large pause. Now, in the bridge space, there were financing counterparties that just decided not to lend on bridge anymore overnight. And a lot of that is the gun shyness from the last financial crisis. So they made snap decisions. But over the course of the last, I'd say 10 weeks, you've started to see some of that come around. Do you want me to broaden on that more, Jeff, or is that good for now?
No, that's super, but I would like to follow up on the repercussions for, and our investors are going to be interested in hearing this because they really need to understand why lenders paused. And to direct a question regarding the repercussions of having to sell loans out of the portfolio in order to meet those margin calls and the ramifications that each individual lender really felt from that. Could you just expand on that a little bit?
So basically, if a lender doesn't have enough money to pay their financing counterparties on their margin calls, one of two things can happen. They can either sell off assets themselves, raise enough capital in order to give the money to the financing counterparty, or quite frankly, if they can't do that, the default provisions in those financing facilities allow the guy who's financing you to literally take your entire portfolio of loans. If they take the portfolio of loans, what they're going to do is immediately liquidate and sell them most of the time to raise as much money as humanly possible to pay down what they already have financed with you, and then they're going to turn you off from being able to have any other loans fund. In addition, if there's other loans and they know that you have additional value in your portfolio or that your business actually has money away from the assets that they're holding, many of these facilities are recourse-driven facilities. They'll come after the rest.
Yeah, and I think that's really well said, Jennifer. At RCN Capital, we certainly saw the ramifications of what was happening in the securitization market, which is the bonds that you spoke to, which was, the warehouse facilities. Fortunately for us, we have a large amount of our own equity. Warehouse facilities is a secondary funding source for us. We fund a lot of our loans with cash. But like every other lender, we saw the ramifications of the bonds being really just the inability to price them. And it was just a horrific scene from about March 15th all the way through the end of April to when those bond markets began to thaw. And, Kendra, I'm going to follow up with you. Certainly at Civic, you experienced a lot of the dramatic changes that Jennifer spoke of. Maybe you could talk a little bit on your team and how you've been able to navigate these new waters.
Well, I feel like I'm in a dinghy boat in the middle of a storm, honestly, but we kind of have just been rolling with it. And what I mean by that is there's no other way to deal with it but to either pause or to go after it as cautiously as possible, mitigating the risk of the unknown, right? So to Jennifer's point, I'm fortunate enough to be sitting in a vehicle like Civic where we had enough liquidity, we had enough equity, we had enough forward commitments that were honored so that we weren't stuck with a large amount of margin calls. And the ones that we were positioned with, when and if we were prepared to come to the table with that. So from an origination standpoint, I think Jennifer did a great job explaining what is happening from a secondary standpoint. Pre-COVID, there was less noise and there was, things were trading significantly lower. So we were able to originate at, pretty competitive price point for a long time. And we all got a little bit spoiled, because money was turning so fast, very competitively. And now post-COVID, or I'm calling it post-COVID, but we're not out of the woods yet. There's more noise and we're trading at, high 80s, 90s, which obviously doesn't lend to a very profitable business model when you're originating at even 12%. So from an origination standpoint, I'll just tell you, we were forced to pivot dramatically. Overnight, we had to increase rates 200 basis points and reduce leverage, 10% or more. And we were still being told by our institutional partners that we were absolutely ludicrous out of our minds, but we were prepared to hold that paper if need be, because in our mind, we feel like, originating paper at 65 to 75% on an aggressive, tier one borrower, it's still 100 at 12, let's say 10 and 2 or 12 and 2. It's significantly better paper than we were originating in 2019. So to hold on to it for let's just say 3 months would have been a better option than us selling at high 80s, So we continued on with what we felt was best, best risk mitigation by pricing and leverage.
No, that's really well said, and I think that's a lot of the same feedback that we've been seeing at RCN across the country, which is the qualified investors, while a little higher coupon, a little lower leverage, not pleased with the new terms, but understanding of where the new reality is. And Jacob, that's a great transition to you, which is at Bridge Loan Network, you're talking to lenders all across the country on a regular basis. What are you hearing from the boots on the ground out there?
Absolutely, yeah. Thanks, Jeff. I would echo a lot of the points made by Erica and Jennifer that a lot of lenders did have to adapt and change leverages, pricing, and things of that nature. It's kind of industry norm right now that most people did have to take a leverage hit on all their products, including short-term and long-term. So that's pretty much the industry standard. What I'm hearing from borrowers is the more lenders they talk to, the more that is the answer that they're hearing, where there are leverage cuts and higher interest rates.
So with that said, Jacob, you mentioned borrowers. Are borrowers still willing to execute at these new terms? What kind of feedback are you hearing?
Yeah, absolutely. I would say that the most aggressive borrowers are still out there, accepting these funding options that are available. I think, again, like you mentioned, Jeff, liquidity is probably one of the most things concerned for those borrowers. But what I've been seeing is if the liquidity is there, that is a stronger play as far as concerned with experience. That liquidity is going to play a bigger part than experience will moving forward here.
Liquidity really is been the new caveat in everything that we're doing, whether it be showing liquidity reserves via bank statements or doing some sort of an interest reserve. And, the liquidity discussion is a great transition to Nathan. Nathan, so many people have so much money locked up in retirement vehicles. And since liquidity has really become a new focus for the residential investment space, I think you'd be the perfect candidate here to discuss on how folks can unlock that and work with private lenders across the country.
Yeah, I've been listening to everybody, and I'm kind of getting my own education because I'm on the different side of it, right? What I do is I privately loan. I fill in those spots where the banks aren't taking place. Well, if you go pre-COVID in my space, I was getting squeezed pretty hard. In other words, there are a lot of private money lenders coming in. It seemed like there was a lot of deals on the market. It was really hard for me to find a decent deal. So I'm not sure how it's going to affect us. I can tell you this. There's a lot of private money out there right now looking for deals, myself included. I know during the COVID time, I got four payoffs from private lenders, and I have no deals being submitted or nobody is asking for money that I can see. I think a lot of it is just because the courthouses and stuff are cut down, so that people aren't buying at the auction and things like that right now. They're just not available or open to it. But I think that if you're a real estate investor, you need to open yourself up to all the avenues that you can. Understand that, yeah, money's going to get a little bit tighter. It always does in these type of situations, right? But money's just like anything else. It's a cost of roof or a cost of a floor. It's just a cost that we have to figure into that deal. But I think the real trick is to understand the new banking programs, make sure that you develop good relationships with the banking programs, and start to learn developing relationships with private lenders. Private lenders are different, right? Typically, if you find someone that will loan you privately on a deal and feels comfortable with that, they'll continue to do that the rest of their lives. So it's a lot about building a relationship. And I think a lot of people don't understand this very well, and they're very nervous about doing that. And so as a result, they never explore too much the private money lending. They feel like they're going to be like a beggar or something like that. And honestly, most people that would bring me a deal or anyone else that's a private lender, you're really solving a problem for us by bringing us a deal. The money's no longer just sitting there. You know, we have it actively working and all types of stuff like this. I think that a mental block a lot of people have about finding private money is just how to ask for it and what to do.
No, that's well said, Nathan. And, you know, private money, you know, we started our company back in 2010, as I mentioned on the intro, really going into what was going to be the recovery from the Great Recession. And what our focus was really figuring out a way to take that hard money and make it a commercial loan product. And I think what you just touched on, which is accurate, which is a lot of folks don't understand just how sophisticated private money is today and where it's come. And with that said, I just want to go back to Jennifer again, because Jennifer, I really want the audience to understand today the plumbing behind the system on how the private lenders on this call, as well as our fellow competition around the country, I want folks to understand just how the plumbing works from a standpoint of securitization, which enables myself and other lenders to be able to really access pools of capital that drives down rates to certainly areas that we're competing one-on-one with institutional players, not uncommon to be the local bank when it comes to long-term rentals. Could you talk a little bit about, you know, the liquidity and how aggregators are looking at securitization, especially on the rental side of things coming out of the pandemic?
Well, I think that you have to look at, you know, some of the historical bond trading and where pricing has been driven to. You know, even some of the 2020, you know, single-family rental bond issuances, and bond issuance in 2020 was down anyway. You know, meaning less was securitized earlier in the year than year prior. You got bonds with 35% subordination versus the risk of non-payment pricing under 100 cents on the dollar. Okay, and there's been no widespread, you know, devaluing of the real estate. Okay, there's been no widespread forbearance given for non-payment of rent. There's been certain states that have issued eviction moratoriums, you know, for 90 days or whatnot. But in many cases in the single-family rental world, the investors would work with these inhabitants and tenants for 90 days anyway. So I think that some of it's mountain versus molehill. But you have to think about what the en masse impact would be if all of a sudden the government said, all rental property inhabitants do not have to pay their rent for 120 days. Okay? So very much like what just happened in the mortgage market for, you know, Fannie Mae and Freddie Mac loans, you had the conservator of those entities say, hey, you know what, you don't have to pay your mortgage for 90 days. And we're going to, you know, do it on an honor system. So you don't even have to prove that you have a hardship. So if all of a sudden you had that happen to rental payments across the entire nation, you have to keep in mind that the manner in which the investors who buy these bonds make money is cash flow. Okay? So that cash flow wouldn't be there. So the reason you're seeing a significant devaluing in certain of the single-family rental securitizations is, one, some of the lenders that make up those securitizations are now gone. Two, everybody saw what happened on the financing side that I mentioned earlier for single-family rental loans. To Kendra's earlier point, interest rates have gone up between, by the way, 200 and 400 basis points, depending upon lender. And now you have the private lender looking more like a hard money lender, which I think, you know, should have more of a distinction, right? So you can't necessarily say, hey, bondholders, don't worry about it. You know, you're going to go back up those 3 points. You know, 3.5 weeks from now when all of us don't know exactly when we're going to get out of captivity. And we don't actually know what the overall impact is going to be to the real estate market. So if you're a bondholder buying SFR bonds, you're basing it on underwriting characteristics versus rental cash flow to a debt service coverage ratio versus property value. And in a coronavirus world, we don't know what the impacts are going to be to property value until such time that we know how long this is going to possibly take to end. We don't know if today the government will legislate people being not allowed to pay their rent. We already have seen eviction moratoriums, not only for rental property, but also foreclosed mortgage property, et cetera. So the investors are currently pricing in that risk and driving down the value or the buy price or trade price of these bonds. But even away from the investors, when the investors buy bonds, they also leverage those bonds. So similarly to the loans that people leverage up so they can lend more, the investors also lever up the bonds. If it gets more expensive for them to be able to finance or leverage those bonds, they also pay less for the bonds. Does that help, Jeff?
It helps a tremendous amount. And I think really what it comes down to, and I think our audience will appreciate this, especially as investors across America, is it's really all about pricing and risk. And I think you did a great job there, Jen, of explaining sort of how it all works behind the scenes. So we're going to transition now a little bit on the liquidity and sort of how things work behind the scenes to frontline issues. Before I get to that, I'm going to remind everyone that we do have a question box available on your screen. Feel free to put in questions as you see fit. You can make them general questions or you can direct them to each panelist. And we will leave some time at the end of today's panel to be able to get to those. So, Nathan, I'm going to be coming back to you now. The reset that we're at today, certainly at RCN Capital, our phone is ringing like it hasn't rung in 2 months over the past couple of weeks. But what I want to get a feeling for is what kind of reset that the virus has sort of put out amongst the lenders in the community. So not only pricing, I'm also interested in products, guidelines. As an IRA self-directed as well as an individual lender, have you changed things up, and what are you seeing in this new COVID-19 era, Nathan?
I got to be honest with you. I'm still waiting for the dust to settle a little bit to even know, because there's been so much movement. It's like a game of marbles. Everything's moving in all directions at the same time. And so there's a funny thing. There's been a lot of money come out of retirement accounts. There's been a lot of people taking cash distributions, to solve their personal problems. I've seen a large sell of assets, or a lot of money coming back into our accounts from people actually selling out and buying things. And I'm still seeing some transactions. I'm going to give a caution out here that maybe some people haven't thought about. I also see a lot of people that all of a sudden are getting scared about things, and they're jumping in to be a private money lender for the first time without very good training, without know what's going on. And man, that's dangerous. You lenders know. So for me, an increasing amount of my money, I actually will go to either a hard money lender or another lender. They'll vet the loan, and I'll be buying the loans out from them. Well, why? I'm experienced and everything else. It's the time it takes to vet some of those loans, and it took me a long time to learn how to do that well. And I really worry about some of the people coming in the market that are just going to lend to some people that probably aren't very loan worthy. So there'll be some of that taking place.
No, that's well said. Certainly in this new reality we have today, underwriting is a component that it can never ever be too underestimated, but in today's new world, underwriting is everything. But Kendra, I'm going to transition to you, and I'm going to pose the same question to you. Pricing, products, guidelines, how have you changed? And from a boots on the ground standpoint, what are you hearing from your customers?
Well, I mean, look, Nathan's right. Or I don't know if it was Nathan or you that said it. it's just extremely, extremely busy. But I feel that the quality has shifted so much that busy is one thing, good quality deals is another. And because of these overlays, whether they're COVID overlays or here to stay, we really have to look at a quality underwrite versus what we would have allowed to go so heavy dominant asset driven prior to COVID. So I feel like the game has shifted a little bit. It's not about going against competitors that share similar product boxes with similar underwrite. It's more about going against the old school hard money lender, the country club money, because they've always been lending at 10, 12, and 2 to 4, right? So it really presents a different challenge because we're still asking for the heavy underwrite. We're asking for deeper dives on, liquidity. Can we hold that interest reserve? And what's their experience and how much cash are we giving them? I mean, so yeah, I would tell you, I think that there's definitely restriction, or I hesitate to call it restriction, but there's definitely a deeper look at how we're allowing funds to be allocated, and we're pricing accordingly. So to Jennifer's point, yes, most people went up 400 basis points in price if they stayed in the game. We are fortunate enough where we went up 200. That doesn't make us better. That's just what we decided to do as an organization. So we went up 200 basis points and, like I said, dropped leverage. So are we feeling that restriction? Yes. And quite frankly, I'm going to deflect to what I said first. I feel like we are originating better quality loans. So contrary to what Nathan just said, I feel like we're actually originating better loans now in COVID than we did in 2019.
Yeah, it's interesting. Some of the data that we've been pulling at RCN Capital supports exactly what you're saying, especially on the rental side. In April, we had a 5% default rate of our customers, meaning the data that we collected from our borrowers said that about 5% of their tenants did not pay the rent. The typical month is 2 to 3%. So that was really a strong number, and we're expecting to see that same number again in May. So we've really been pleased with some of these data points that we're seeing, especially in the areas that are known for large aggregators of single-family rentals. The bridge side, some of it is COVID-related to certainly restrictions on being able to conduct business, whether it be in the Northeast or a few other selected geographic regions. But once again, our customers are still out there pounding the pavement looking for properties. So whether it be a little lower leverage, a little higher pricing, it doesn't seem to have decreased the demand. And, once again, Jacob, you mentioned that you have a good pulse through Bridge Loan Network on everything that your lenders are saying. What feedback are you getting? And if you could be specific, pricing, product, and guidelines, that I'd love you to drill down there.
Yeah, absolutely, Jeff. So to echo some of the points made by some of the other panelists, we've definitely seen lower leverages, higher interest rates. That's pretty standard across the board, across the country. Now, with that being said, what I saw a lot of lenders do when they entered the market, in the middle of this whole pandemic, was, again, stronger look at liquidity, a little deeper dive into the background of their borrowers. But the other thing I saw was a lot of lenders just dealing with repeat clients. So one thing I would definitely urge all of our direct borrowers out there is think of your lenders as partners, right? So as things come up like this, you want to be paired with a strong partner that's going to keep you updated on what their products and terms are going to look like as things open up here during COVID. And I would say that borrowers are definitely more apt to work with those folks that are being transparent on pricing. As I mentioned before, it's pretty much standard right now that there have been leverage drops and higher interest rates. So as long as borrowers understand that and it's clearly represented by the lenders, I see a lot of borrowers having no problems with this. Obviously, it's not ideal, but they're able to adapt on what's required now and find deals that may fit those new product guidelines.
So when you're speaking with your lenders across the country, what's the sentiment that you're getting from them, and has it evolved over the past 2 months? How are they feeling that their customers are interacting with them today? Has it changed at all?
Yeah, I would say there's a lot less people out there feeling out options. You know, before, when the products were very competitive, borrowers and their brokers that they might have been working with can shop around for better deals as far as pricing, leverage, and points. Now, again, it's kind of more standardized across the country. So just being able to identify those strong partners, the folks that are going to be transparent about what their products are, I think that's gone a long way for a lot of these borrowers.
Well said, well said. Kendra, let me ask you a very simple question that I know is on the minds of our audience today. Are we going to get back to the way it used to be 2 months ago?
Of course you had to ask me that question. So if you're asking me personally, I would love to believe that it will. I think it's just going to be a long, long time before we get there. When I say long, long time, I don't think it's going to happen 2020 personally. I mean, to Jen's point, I believe that securitizations will have to come back to help some of these lenders recapitalize or recirculate their money, just because most people don't have the liquidity on their own to support their existing relationships. So, you know, I've already seen a drop slightly. People, I would say best case, we're going to settle into the quote unquote new norm, both this month and the next few months. And depending on how quickly everyone is, quote unquote, released from quarantine, then I think it will be a tell. And furthermore, those papers starts to really trade, what that price point looks like. You know, I think it's just going to take some time. This is not just a liquidity issue, it's a social issue. You know, I mean, this was not a depreciation of assets. It was, you know, a fear that came from, it's hysteria rather, that came from this pandemic. So it triggered this domino effect, not just from, you know, the lending standpoint, but a social standpoint. So it's kind of an awkward time. And so it's this unknown time frame, you know? So simply stated, I would love to believe that it is, but I think it's going to be 12, 18 months minimum. That's just my feeling.
Yeah, it's interesting. We get at RCN, we get that question asked. I mean, it's just never ending. Well, you know, when are the terms just going to go back to the way they are? And, you know, once the country's opened up, shouldn't they just return to the way they are? And, you know, we've been transparent from the very beginning. It's one of the reasons that we paused lending, because there was so much uncertainty in the marketplace, and we didn't want to put rates and terms out that we couldn't honor. And today, while the rates and terms that we're offering is competitive, you know, same as any other lender, we're also being transparent with our customers, saying we are still going into an unknown period, which is we don't know what rates are going to look like 60, 90, 120 days today. But if you're buying the property right, and, you know, Kendra, certainly we touched on this, right? The underlying asset, if you are buying the property right today and the numbers pencil out, the cost of financing should be, while important, certainly secondary to your rate of return on your investment. And I'm just going to give that as a quick follow-up to you, Kendra, is, you know, how are those conversations going on the return on investment as it pertains to the cost of financing, and how you make, you know, the pot of soup there?
You know, that's funny that you're bringing that up, just because, like you know, we get some of these same questions over and over. They're so redundant because people get so hooked into what was instead of settling into what is, right? And they're losing sight of their objective as an investor or as a broker that's helping an investor, whatever the situation is. So, I would just say, you know, when the rental product kind of fell off or changed its face for some, right? People were so they were so held up on this rental product. You know, they loved the idea of locking into this deal, and it forces you as an originator or anyone that's, originating this type of business to ask your business partners, what are you really trying to accomplish? Maybe you need to look at your business model right now, because I could give you a rental loan. I mean, I've always had the rental loan, right? So I could give them a rental loan at 8% or 8.5%, lock them in for a 3-year loan. But what does that really mean? You know? So I would just, my feeling is it's a time, I don't know who said it in terms of panelists, but it really is a time to evaluate partnerships and use this as a pivot to help people. And then it's no longer about price and leverage. It's about their business model, you know? It kind of shifts the pressure of, we're not just the big bad lender who cut everything and these people don't understand. It really is a time where everybody should be forced to look at what their business model is and how they can pivot. Just the same that we had to. It's just we're forward facing with how we had to.
No, that's exactly correct. And, you know, Jennifer, you're speaking to lenders, you're aggregating products. When you're working with your lender partners and they say to you, Jennifer, what has to happen for our rates to begin tracking the other direction? What kind of answer are you giving to them? And if you could be specific on how those data points that you're reviewing have to show up so that we can begin tracking the other way as it pertains to rates and leverage.
So as an aggregator, we actually prescribe, at least at Mortgage Venture Partners, what the underwriting guidelines, characteristics, and rates are for the loans that we're willing to buy, and then we issue a rate sheet. And, based on how they're originated is what we're willing to pay for the assets. But the simple answer really is liquidity, right? When you're in an unknown, non-pivotable, pivotable or trackable or modelable zone, like we all are right now, there really is no way to predict that liquidity. So I think Kendra said it well earlier. They cut their leverage ratio, they up their interest rates, knowing that they may not be able to lever up assets that they're originating. So, when you think about that from an aggregation perspective, and we work with a ton of different lenders, right? We have to think about not only the risk of the individual lender staying in business, but then on top of that, the risk that we won't be able to recycle our capital, right? And, away from just financing, et cetera, many of the aggregators, are residential, REITs that are investment trusts, hedge funds, private equity vehicles, et cetera. The other thing that nobody's really talking about in the market, because they're spending so much time looking at warehouse and looking at securitization, is what about the capital raisers and the investors giving money to those entities to put that money to work? Many of the largest real estate investment trusts, hedge funds, and private equity vehicles, and even the mid or smaller size guys, all of their newly raised capital that was supposed to fund this year for them to put to work was paused so that the independent investors that make up that capital could get their arms around the market, right? So when that happens, they also don't have as much money as they thought they were going to have at this point to put to work, right? So they have to choose accordingly what they're buying, right? So do I think that this is going to get back to the pricing levels of, I think you said 2 months ago? Yes. Do I think that Kendra's right, that it takes 18 to 24 months? The answer is yes or no. And the reason for that is, if we actually were to be able to rein in this pandemic tomorrow, okay, and we were only in a 12-week scenario, I actually think that you'd see a significant amount of recovery more quickly. If this continues on, let's say until December, I actually think you're more looking at 3 to 4 years. And I think that you see, depending upon if the aggregators and investors close their money that's been delayed or not, I think you're seeing interest rates probably sit closer to the higher echelons of where they are now, which is the plus 400, plus 300 for probably the 18 to 24 month timeline that Kendra was referencing before. So my humble opinion, it's just my opinion, is the sooner we get out of this, the better.
I could not agree with you more, Jennifer. So
one
as
other
the
thing,
hour,
Jeff,
I'm sorry, go ahead,
one
Jen.
other thing. Yeah, sorry. There's one thing that people need to keep in perspective that I don't think anybody talks about, okay? The U.S. economy lost over 30 million jobs in 6 weeks, okay, because of coronavirus, all right? That's more than the U.S. economy experienced in loss for the entire financial crisis, okay? And the U.S. death toll from coronavirus is bigger than every person that the U.S. lost in the Vietnam War. Now, if you can put that in perspective, that tells you why we're sitting in the limbo that we're sitting in. Remember that the financial crisis was a crash from an employment perspective over a 2 to 5 year duration, depending upon which investor you talk to, okay? But the Vietnam War also wasn't 6 weeks long, right? We're in a 12-week scenario right now, and we've lost more Americans than an entire wartime for something nobody could have predicted.
Very well said, Jennifer, and I think that brings certainly everyone back to a dose of reality of how we got to where we are today. So as this hour is flying along, I want to go back to really being drilled down on how our attendees across America can work with lenders and really understand what the new reality looks like. And Nathan, I'm going to start off with you, and maybe you could throw out some best practices, and certainly because of your company's work with IRA and investing retirement funds, maybe you could throw out some best practices on how folks today could really prepare themselves to be able to put capital to work.
Well, again, I'm a lot different than the rest of the panelists in that my people don't have the resources you do, right? We're just private money. We're some type of engineer or something that has a retirement account. And now I've decided that I'd do better off buying into loans or lending it out. So we don't have all those underwriting capabilities that some people have. That's why I was giving my ear to caution there. But if you want to enter the field, I think the main thing is whether you want to lend your money or you want to borrow a private money, is take the time to do it professionally. Always make sure that you have professional people that will help you to draft up the documents that are applicable to the state that the piece of real estate it is in. For lenders that are out there that are looking to seek money from private money, understand that private money is just a niche. It's there to fill in the niches in between the banks. And that they work with the banks a lot. And if you don't, like I was trying to say before, if you don't think you have those skills or don't think you know how to do it, sometimes you're better off to use a third party. Like often I will loan to a bank and then the bank will loan the money out for me, or they'll do my underwriting for me, of course, for a pretty good fee. But in the end, I'd much rather receive a little bit less money as a lender and get my money back than go through a scenario where I may not be getting my money back. And honestly, I know there is something that is happening, is that private money hasn't gone up in cost yet. So I think someone else said it, and I forgive me, I don't know who, but your costs are going up, but they're kind of coming in terms with competing with hard money or even private money. Up to this point, private money kind of filled that gap between what the banks were doing and what hard money was doing. There was a little gap in between, and that's kind of where I would play my money. Well, that gap's kind of disappeared. And so what's kind of happening is there is hard money out there, or money like mine, private money, not hard money, that is starting to build up. And it's going to be interesting to see how that falls out. We're going to have to invest it somehow as private money lenders. And I think a lot of us are doing the same thing I'm doing. We've just stopped for a minute because we don't know what to do. I've learned a lot from just listening to the other panelists, though.
No, that's well said. And, you know, one of the things that we've been working on at RCN Capital is working with our experienced investors, making sure that they understand what our new guidelines are. And really, from an underwriting standpoint, they haven't changed. Our underwriting guidelines are virtually the same as beforehand. You know, we expect a valuation. We take that valuation. We make sure that the investor has the comps in the neighborhood to be able to justify the amount of expense that they're putting into that rehab, and make sure that they're going to have a return on investment, especially post-closing, with respect to all of the fees and charges that they are expending after closing. It's not just, well, what am I going to put into the rehab and what am I going to sell it for? There's cost of financing. There's cost of selling the property. There's cost of taxes on the property while you hold it. All of these need to be taken into account, and really they haven't changed at all pre-COVID to post-COVID. At the end of the day, what we're seeing at RCN is if you are buying that property right, you are going to make money the same way you were before. And that's really exciting. It's really exciting. Kendra, once again, boots on the ground. What are you saying to your customers from a standpoint of how you're doing out there today, what you're requiring of them, and how they can be successful?
I mean, I think this trickles through, Jeff. I think that when I'm originating a deal with any of my partners, I think transparency has been the key all the way through this, from my internal team, executive team, all the way out to my external customer. I think people are quicker to settle in and accept what it is and understand that your philosophy and your objective to consistently help them with their business model and not punish them, that there's a bigger thing going on, but the opportunity on the buy side is there and we can still help them execute. It's kind of like tomato, you know? I feel like people are extremely receptive. And to your point, Jeff, my team is extremely busy. We're having almost record months. And so what that's saying is, as long as the money makes sense and the buy makes sense, to your point, there will always be clients out there that will utilize private money, hard money, because they don't have to face the same restrictions they're forced to face in the bank world, right? You know, it's just not, it's so much easier and it's so much more palatable, even when there are overlays. I feel like transparency is the key.
No, you're 100% correct. And that transparency, it's something that never goes away, right? It's pre-COVID, it's post-COVID. The benefits of using a sophisticated lender and developing that partnership that everyone's been talking about today on the panel is just key, especially when it comes into an environment like we are today. That partnership with really a private lender that's been around, such as, you know, a national lender, whether it be a Civic or an RCN, the lender's ability to be able to take that deal that our customer partner is bringing and really tear that deal apart and be another set of eyes on that deal to make sure that our customer / partner is not missing anything. That due diligence that we perform internally goes a long, long way to making sure that our customer is doing the right thing, that when they buy that property, that on the other end of this, when they go put that property up for sale, they're going to make money. And it's something that, you know, at RCN, we're super proud of, that it's truly a win-win. We don't want to make loans to customers who are not going to make money on those transactions. Kendra, I couldn't agree with you more. Jacob, for you, working with those lenders across the country, could you please give some best practices on how borrowers should be interacting with these lenders today and going forward?
Yeah, absolutely. And to echo your point, Jeff, think of all of our investors out there listening. Think of your capital partners as just that, a partner. This isn't somebody that's going to lend you money one time and you're never going to have to talk to them again. These are people that you're ultimately going to come back to again and again to get more loans. So develop that relationship. Use them as a partner, not just a capital resource. With that being said, the better your partnership, the more transparent the lenders are going to be. As Kendra did mention before, the more transparent the lenders are, the more time that's going to give borrowers the ability to get their liquidity in order, to identify properties that will become loans that are actually fundable. Again, to echo that point, I would just say, if you are a direct investor out there, speak with a loan officer or your representative at your lending company. Get a really good understanding of what their underwriting guidelines are going to be for now and moving forward, just so that you guys can identify properties that will actually be fundable.
You know, that's well said. So I'm going to get to just a couple of questions here before we wrap up at the top of the hour. And Kendra, I'm going to throw one back to you. So we've had several questions in the chat box regarding FICO scores. You know, FICO scores are something that customers often ask about, but every lender seems to treat them a little bit differently. Maybe you could talk about FICO as it pertains to short-term bridge as well as a rental loan and how you look at that, Kendra.
Okay, sure. So FICO specifically, we're actually still going down to less than a 499 FICO. Obviously, there's leverage restrictions with that or leverage hits. So every loan has loan level adjustments, and those adjustments are based on FICO, experience, and whether or not, for Civic, if they close in an entity, because we are business purpose, but we do allow you to take ownership as an individual. We prefer that you take ownership as an entity, so we give you a price, a betterment to pricing. So to your point, to your question, 499 is going to get you, let's say, 55-65% leverage, right, on a bridge or a fix and flip style product. And then for our rental product, you must have a 600 FICO or greater. And more importantly, on the rental, obviously, it's a debt service product. So you're going to have some challenges unless your buy is exactly right, or you've been carrying that property with very low leverage or non-existent leverage. You're going to have a difficult time debt servicing at the now rates at 8.25, 8.5.
Yeah, it's interesting. FICO, really from the RCN perspective, has always been really not very important at all on the bridge. We always look at these short-term buy, fix, and rehab loans as a true asset-based loan, meaning that we're underwriting the deal and whether or not the borrower is going to make money at the end of the day. And that's really how we always looked at FICO. So, you know, like you, we had an extremely low barrier for FICO scores because we knew that we're pretty much only have 12 months of payments that we're expecting. And if the borrower couldn't make those payments, it was relatively easy to be able to repurpose that loan and get the deal done. However, on the rental side of things, FICO is much more important because it goes to a history of long-term performance. And when you're putting a tenant in a property and you're making, whether it be a short-term sort of bridge rental loan, whether it be a 3 or a 5, or our extremely popular 30-year product, which the phone continues to ring like crazy for, FICO really becomes an important caveat in that because at the end of the day, those 30-year obligations that we're originating go into that bond market, and FICO becomes important on that. And, you know, Jennifer, maybe I'll toss it over to you to maybe talk a little bit about why FICO is important in this long-term debt on the rental portfolios that we're originating.
Yeah, so I tend to agree on the shorter duration collateral that the FICO is not as important, but then I say some unpopular things that everybody else says we're supposed to focus on. So I don't actually think the FICO is as big a driver on the longer duration landlord loan either. And the reason for that is the reality of the propensity to pay on the longer duration landlord loan is, do you believe that the borrower, entity, or human is actually capable of properly managing the asset? And if, in fact, they are properly capable of managing the assets, then in theory, the tenant should continue to pay. And then if, in fact, they have to evict a tenant, they should be able to actually rent out that house at proper market levels within a reasonable duration of time. So unlike a lot of aggregators that really focus on FICO, I really only focus on FICO from the aspect of I know I'm going to get hit by a rating agency if we securitize our single family rental if we don't have a certain average FICO. But the reality is, in coming out of, working more full life cycle throughout my career on kind of the happy side of origination and the not so happy side, on the defaulted side, my humble opinion in single family rental is it really isn't all that important. It's really more about, is your property manager or your borrower is self-managed, truly able to keep the property rented, collect those rental payments in a timely manner so that the cash flow that we all underwrote to will actually exist to pay back the debt. If the answer on that is yes, and that we can actually obtain the actual rental amounts that we've modeled from the origination of the loans, I think that you're in a good performance metric. I think in a market like this, an investor such as myself thinks more about, do we pull back the allowances on longer duration landlord loans that don't require lease in place? So when you look at the underwriting characteristics, there are loans that are required to have an already executed occupied property in place, and then there are others that need to be leased within X duration of time. When we're in more of a coronavirus village, I really focus more on, I would like to know that a tenant is actually in the property and that the property is cash flowing versus the vacancy factor on the properties that, for example, are in the buy to rent conversion status where they haven't actually leased the property yet. So for me, that's more interesting to me right now in a non-predictable market than the actual FICO of the underlying borrower, sponsor, et cetera.
No, I couldn't agree with you more. And it is frustrating, our 30-year product has these overlays, whether it be, lease in place, is tenant performing, FICO, geography, and I couldn't believe with you a more transparent look as to whether or not the property is going to perform, when the day you close the loan, and less looking at FICO, worrying about payments from 5 years ago that possibly skewed those FICO scores. Really well said, Jennifer. And unfortunately, folks, we have come to the top of the hour here for our funding strategies, expanding your portfolio panel today. But what a panel it was. A big thank you to Nathan, Jennifer, Kendra, and Jacob. All of your content was really so timely, and I couldn't really ask for more from any of these panels I've been moderating. Thank you so much. Once again, Suzanne and Robert from REI Inc., you've done a tremendous job. Thank you for putting this panel together today. It's been a pleasure to moderate. Once again, my name is Jeffrey Tesch, CEO of RCN Capital. Thank you so much. We will see you again in 2 weeks. Good day.
Thanks, everybody.
Thanks, everybody. Bye.